Hello, welcome to Caesar's Snack Sandwich. Today we're going to take a look at FRAX Finance. Now I looked at FRAX a little while ago, sometime in May perhaps, but there's a lot of change. There's version 2 basically with a lot of interesting new factors to it and a lot of big changes. So I'm going to go through these big changes and I'm going to talk a little bit about them. The major changes is what they call AMOs. Now, you'll understand these AMOs as I go through them, but if you want a deeper understanding, I do suggest you go to the documentation and read through this section here from AMO down to decentralized ratio. I'm going to cover most of this today in a flowchart, but I'm also going to talk a little bit about this veFXS or FXS token and why I'm kind of bullish on this token particularly. Okay, so let's swing over to this flowchart and talk about it there. Okay, before I can talk about what's new, you need to understand the factors of FRAX. What makes FRAX an algorithmic stablecoin and how they are the rules of FRAX basically. So we have these tokens here. They have the FRAX token, which is pegged to the US dollar. It's an algorithmic stablecoin. We have this FXS token, which they call the share token, and it has a lot of features inside FRAX, which I can't get into all of them, but basically governance as well as it's partially backing the FXS or the FRAX token, okay? And then we have the backing collateral. So sometimes, depending on the chain and so forth, there's a whole bunch of choices now. But like, for example, we're going to use USDC, but it's some sort of a trusted stablecoin on the chain that the FRAX is on. So we're going to use USDC in this example, but know that it's not always only USDC backing FRAX, okay? So if we go to number 1, we have D-collateral. So every time FRAX is above $1 US, then the collateral ratio goes down, meaning less USDC. So when FRAX first came out, one USDC was backing 1 FRAX. But as people trust it more and the dollar value of FRAX goes up, then the need for the USDC backing goes down, and then we can add more FXS as backing. So it's still $1 backed, but the partial part of it is USDC and a part of it is FRAX. So when people come to redeem this token, FRAX, for the underlying, they will get 2 tokens instead of just 1. Now, I'm not going to get into all of the redeeming and stuff. I'm just going to talk about this AMO stuff, okay? So number 2, when the FRAX is equal to $1, then there's no change, of course. It's stable and there needs to be no changes. Now they have this thing called recollateralization, and I think that's when FRAX is below peg and they need more trust. So they will increase the amount of USDC backing and lower the amount of FXS token backing, okay? And then they have this other thing, number 4, which is FXS 155.9 or 1559. Now what that means is whenever there's some profit generated, they want to burn this FXS token, okay? So they like burning this FXS token so that the FXS token can go up in value. Now, like I said, this FXS token has other use cases beyond just backing this, and that's why there's VE token model for it. So we'll get into this more and more as we go through this flowchart and you'll have a better understanding. So I hope this is clear now, how FRAX is an algorithmic stablecoin and it's partially backed by some trusted stablecoins as well as by this native FXS share token. Okay, so the first thing we have here. Now, there's a bunch of USDC sitting inside the protocol. So as time went by, they're like, hey, we can't just leave this USDC or these stablecoins sitting here. Let's put some of them to use. So as the protocol is goes above the value, then they say, oh, we've got extra USDC or extra stablecoins in there. So let's put them out into DeFi. So, put them into they call them collateral investors. So there's a whole list of them. I'll show you later when we go into the DApp, all the different possibilities. But here are some examples, like some trusted, high quality investment vehicles that are redemption 1-to-1, like the zero loss type stuff. Like if you put 1 USDC into Yearn, Compound, Aave, you will be able to get 1 USDC out later, right? Now, anytime that there is any kind of whenever this number 3 comes in, the recollateralization, like the peg is below, then they just pull these back so that these are here so people can do the redemption. So people can bring back the Frax and redeem it for USDC. So you buy Frax from the market and then you can redeem it for the underlying asset, and that will help to bring the peg back up, right? So they can easily pull out of these back to the collateral contracts, right? And then number 4, so it's the burn factor, right? Anytime there is any kind of profits from this are used to buy and burn FXS from the market, and 50% is used to just pay to the veFXS token holders. So if you hold veFXS, you're going to get half of the profits from these investment vehicles, right? So the second AMO they have is called the Curve AMO, right? So these are different strategies that they're using to invest their collateral. So it's very similar to this one. However, there's some changes in here. So again, they're going to send some of the collateral and send some Frax because they need to LP the collateral and the Frax into this, where is it? Frax 3 curve pool. Now this 3 curve pool was launched by the Frax protocol. So they have admin rights over this pool. So they're going to supply liquidity to that when Frax is in a comfortable decollateralization system, like when they're able to add more FXS backing, so they can take some of this collateral out and send it to Curve to provide liquidity. Now, providing liquidity on Curve also allows them to help maintain peg outside of just the redemption mechanism and the minting redemption mechanism, right? So they get trading fees from this, and they also get Curve CRV. Now they're locking up the CRV so that they can vote on the rewards for this particular pool. Okay. Now they're also going to take this LP and stick it into these possible protocols, Yearn, Convex, or Stake DAO, to earn additional rewards. Now all those rewards, again, 50% goes to daily burning of FXS token and goes to the veFXS token holders. So as you can see, this is why I'm starting to get bullish on veFXS token holding, right? Now, the third AMO is what they call Uniswap version 3, which is very similar to this one. However, there's no right now there's no safe place to put these LPs, but basically the same thing. They take some USDC or whatever stablecoin is here, and they take some FXS or some Frax, and they put it to supply it to Uniswap version 3. And then again, they get the trading fees. They use the trading fees as profit to daily burn and give to the FXS token holders. Now it does say here, I forgot this part, when there's a recollateralization need, they pull out the Frax because Frax should be above, there should be more Frax inside the pool since it's been trading against. So they'll pull out the Frax and then they'll pull out the USDC and bring it back. Okay. And then the same here, they will pull out the Frax and they will burn the Frax, and then they will return the the USDC back to the collateral to collateralize this up. Okay. Now the next AMO they have is what they're calling collateral hedge. Now I don't think they're actually actively adding anything to this. So the idea of this collateral hedge is that they ask for collateral in the form of some other token that's not a stablecoin, like ETH or here I used ETH, but it could be anything that the governance deems is quality enough to use. And they supply to an ETH up and an ETH down, so they get a delta neutral. So it doesn't matter the price action of this, they'll always have the same amount of US dollar value of tokens, and then they can use that for collateral in the future. So this is one of the things I think they are exploring that is not actually implemented yet, but I could be wrong. The next one they have is what they call, I guess I didn't write it down. They call it lending, Frax lending. Now the Frax lending is pretty interesting. It's quite different than this one. This is taking their USDC and lending it, right? This is lending Frax. So people go to these places like Compound or Iron Bank. There's a whole big list. I'll show you in a second. So they go there and they want to borrow. So they supply collateral to, let's say, I'll just use Iron Bank. So I would bring some ETH to Iron Bank. I would supply it. And then I would want to borrow some Frax. So instead of there being a whole bunch of Frax inside this pool waiting, then the Frax system will just mint it, because now it is backed by the collateral that the person used to borrow it, right? And then they're paying interest on it, right? If the recollateralization comes into effect, they would just basically pull it out, burn it, right? They just burn that minted Frax. But now this is this is one that needs to be controlled, because if you think about it, if I borrow the Frax and it's 100% utilization, if I don't give it back, right, then you can't burn it, right? Because I have it, right? So I think they have to carefully control this. Like, these are probably the majority of their money is being put into these AMOs, and then they're also allowing this to some, like they're controlling the risk factor of this so that they don't have too much Frax here that cannot be backed by the collateral ratio, right? Now, again, you know, you're going to get some interest because you're lending to people, and that interest, whenever it's redeemable, they're going to use that interest to burn more FXS, and as well as give half to the VE token holders. Now, the last thing they talk about in the docs there is they're proposing to get Frax on Tornado.finance. This is the place where you can send your tokens and get a key code, and then come with a different wallet and that key code and pull out of this Tornado. So there's a way to kind of I was going to wash the money, I guess you can call it. I can't remember make it anonymous. Like, where did this money come from? So they're trying to propose this as the Frax to be the main thing, because this should be a decentralized dollar. It's pretty good at being decentralized. There's a little bit of, you know, there is quite a bit of centralization in their collateral, but they're working on making it more and more and more decollateralized. So I think this is pretty interesting. So basically they have all these different strategies in play, and they all follow this set of rules that doesn't break the set of rules that are the initial set of rules that I showed you at the start. They all follow this set of rules. So anybody can come along with an idea. They can build one of these AMOs and they can ask to have it implemented, but it has to follow these rules. So long as it follows these rules, then it can be implemented. Of course, there would be allowances and so forth. So let's go back over to the website and talk a little bit about what is there. So here I am back on the docs. Now, I did say I wanted you to read these docs. You should probably read through this and you'll get a deeper understanding. There's a lot of math and stuff in here. And then I wanted to talk about this veFXS token. So veFXS token is locking your tokens for a long time. So you lock for at most 4 years, but I think the minimum is 1 week or something. And you'll get, you know, a share depending on how long you lock. So if you lock one FXS token for 4 years, then you get one veFXS token, and veFX token decays linearly, and when it's decayed fully, then you can get back out your FXS token. Now, I did say that they are doing those buybacks, which makes the price bullish. They are also, this also will allow you to vote on different factors of the Frax system. It will also allow you to have boosts on different pools that are incentivized by FRAX Finance themselves. And then, you know, you also get that 50% of the profit, which is quite juicy in my opinion, probably. So I'm pretty interested in this. Now, there was one more thing I wanted to show you. Yeah, if you come to the website, the app, actually, there's a lot of buttons, and it's pretty scary when you first click on things and you see all these like things like, what's all this stuff? Right? But now that you have a kind of good understanding of what's going on, you can see that there are, if you go to the AMOs here, you can see that the ones that I have talked about. So the investor, you can see that it's quite invested in quite a few different places. So you can kind of come here and see, oh, how much money is being deployed in each of these different investment possibility strategies. You can click on them to reduce the chart and remove pieces so you can get a better look on what's on in the inside and so forth. You can see all the numbers here. So this is the investor that I was talking about first. And then we have the curve liquidity pool here. And then we have, this is kind of like a whole bunch of different places where basically just showing you all the different protocol owned liquidity out there and where you can find liquidity to trade for the Frax token. And then there's also this, the lending. This is what I told you where they, you go to these different protocols and you can mint these, you can borrow the Frax by basically the Frax system will mint and supply for you. Okay. Now, the last thing I want to talk about is this article here. If you come to Convex article, Convex Medium, they talked about how they have decided to start locking cvxFXS. So I would suggest you to read this, but to give you a quick understanding is basically you can come to Convex now. It's a little bit different. Check frax.convex.finance and you can lock your FXS tokens forever. So you lock them up here and you get cvxFXS tokens. Now, these tokens are tradable. They are transferable. If you have this token inside your wallet, you can move it, you can trade it. It does not decay like the veFXS token. So the veFX token is locked in your wallet forever. However, this one is not. So you can come here instead to lock up your tokens for your FXS tokens forever, but then you get a token that is transferable. In the future, there is going to be a liquidity pool. So that'll allow you to exit your position early if this pool's price suits your desire to exit, right? So you could sell this for this in this pool in the future when this pool is opened. Now, why would you want to do this? Number one, you're going to get an airdrop of this FPI token. Now, I don't know a whole lot about this because they haven't released the news about it completely, but I do know that it's like basically a Frax token that is pegged to the consumer price index, which is pretty interesting. And then you're also going to get the platform fees because you got to remember all those VE token holders get all of those platform fees, and that will come to Convex, and Convex will share it with all the people who do this. Now, Convex has its own voting system, so they're going to vote for you. If you want to know more about how to vote on Convex, you have to search into Convex. It's too much for me to talk about today. So I think it's pretty interesting. I am kind of bullish on this. I think Frax is going to do it. I think they're going to make it. So I like this protocol and I like this idea of locking my FXS tokens here and having a liquid token that in the future will be able to be traded. Now, Convex is no joke. They are not somebody who's, they don't take on any partner, that's for sure. So this is their first partner other than Curve. So I really like this. I think it's pretty solid bet on the future of these guys. Okay, so thank you so much for watching and goodbye.